When discussing strategies for SMCs, it's important to remember to have realistic expectations. It is possible to reduce risk during an SMC, but there will always be risk that remains during a market downturn. There are lots of strategies, and it's not possible to use them all simultaneously, nor is it wise or practical to do so, especially since some strategies can conflict with one another. In addition to the normal learning curve and experience needed to properly apply each strategy, it's definitely best to pick the strategies that suit individual risk tolerance and objectives best. Some strategies just may not be suitable for individual circumstances and preferences, based on additional factors such as personal experience and knowledge. Most strategies first revolve around loss reduction and avoidance, followed by searching and waiting for opportunities that can lead to profit further into the future. And finally, there are strategies that can specifically focus on profit potential during a stock market crash. Naturally, it'll be much simpler and safer to focus on loss reduction and avoidance. While there is potential to profit during an SMC, it will produce some difficulty and much more risk in trying to master certain techniques. The first and one of the most common strategies is to increase cash reserves. This essentially means increasing the amount of cash on hand from various sources such as extra income or dividend payments and existing savings. And it can often mean selling off or liquidating riskier assets, turning them into cash, which is on the lower end of the risk spectrum. Holding cash won't increase wealth, and it can actually decline in value. However, this decline is predictable and stable in comparison to the dropping stock prices during an SMC. Because cash only really lowers in value significantly in a short time during periods of hyperinflation, and that is extremely rare. The main worry is that cash will eventually lower in value due to inflation over time. That's why this is often more of a short-term strategy during rapid market declines. Capital can also be put into cash equivalents that may lose value slower than just holding plain cash in things such as short-term bonds, treasury bills, money market funds, and savings accounts. Basically things that are mimicking or close to the dynamic value of cash, hence the name cash equivalents. The end goal is not to profit from holding cash. Rather, it's to be more flexible and to be ready with cash on hand to buy into opportunities in other markets or when the stock market turns around. Cash can also be related to the next strategy, which involves moving to defensive stocks. So the cash reserves can be put to work during an SMC, which might not always be preferable, but if they are put to work, they are usually towards defensive stocks. Be cautious with such a term. It does not mean that stocks exist where there is a 100% guarantee they won't decline. Of course, most all stocks will fall during an SMC. It's simply that safer stocks, as they are called, are stocks that will tend to decline less during an SMC. Don't be fooled, there's still risk. It's just a lower potential, because such stocks are said to be more stable. They are long-established companies in sectors such as the consumer staples, which is represented in something like the XLP Consumer Staples ETF, normally concerning companies that offer near essential goods such as staple foods and cleaning products, which will definitely still be in demand during economic and stock market declines. Communication services, and to be more specific, telecommunications and major internet service providers, are also said to be more stable and tend to decline less during SMCs, because information and communication are almost essential services in the modern age, such as the traditional utilities that are revolving around delivery of energy, such as electricity. These stocks are likely to weather the storm better during an SMC due to their long-established presence in the market in their respective industries. As well, they often offer dividends, which are still paid during SMCs, but if they are not, they will often be reduced dividend payments or temporarily suspended dividend payments. But the downside to these benefits of additional stability is that such stocks are usually confined to a few sectors, such as the ones displayed here, and that in turn limits the possibility for diversification. Next is diversifying to assets outside the stock market. A classic example is precious metals such as gold and silver, which tend to have an inverse relation to the stock market, meaning that when the stock market goes down, gold and silver prices can often go up. But be warned, this is just a correlational relationship. It does not always hold true, and sometimes the stock market and the price of precious metals can decline at the same time. Correlation does not equal causation, especially with such complex things as the stock market in relation to other markets, not only precious metals, but other assets such as real estate, currencies, and antiques. Similar to cash, precious metals can definitely offer stability, especially in comparison to falling stock prices, but they are often not the first choice of primary growth, even though the metals do see surges in price from time to time. While there is opportunity in other markets such as currency and real estate, those come with their own unique set of challenges. There are complexities in learning about them, just like there are with learning how to trade and invest in the stock market. And as seen with the merging of multiple market influences that can contribute to an SMC, currencies and real estate may be interconnected to a particular SMC, and they too might be plummeting significantly